My question is, if you're investing a small sum today, which approach would you use?
But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now.
Everyone seeks financial security and comfort, but how much do you really need to live comfortably off your investments? Today, we look into the world of ETFs, particularly focusing on VOO, Vanguard's S&P 500 ETF. Guided by insights from one of the greatest investors of our time, Warren Buffett. We'll explore strategic planning and investment decisions and reveal the minimum you need to live off your investments, even if you're on low income. We'll also show you how to use one strategy to turn a small monthly contribution into a $750,000 portfolio.
But that I was working with a tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums, but
Exchange-traded funds, or ETFs, are valuable for investors who aim to diversify their portfolios without the hassle of selecting individual stocks. One standout example is VOO, or Vanguard S&P 500 ETF, which grants investors access to the 500 largest companies in the U.S., covering a wide range of industries. This ETF is especially endorsed by Warren Buffett, who frequently recommends S&P 500 ETFs as safe vehicles for long-term wealth growth. VOO closely tracks the performance of the S&P 500 index, incorporating sectors like technology, healthcare, and consumer goods. This diversity ensures a balanced portfolio, blending growth with stability. Since its launch in September 2010, VOO has been celebrated for its low expense ratio and consistent ability to mirror the dynamic performance of the American economy, making it a favorite among investors seeking reliable market exposure. Since its inception, VOO has demonstrated a compelling track record. As of the end of the last calendar year, VOO has achieved an average annual return of approximately 10.5%. This figure aligns closely with the broader market performance, given that the S&P 500 itself has averaged similar returns over the same period. Such data underscores VOO's effectiveness in providing investors with solid and reliable growth. Warren Buffett underscores the advantage of ETFs, like VOO, for typical investors. He points out that such investments offer a straightforward path to participating in the economic growth without getting bogged down by the intricacies of individual stock selection. This method is perfectly in line with his investment philosophy, which favors acquiring high-quality stocks at reasonable prices and holding on to them over extended periods. VOO is renowned for its efficiency, with an expense ratio of just 0.03%, one of the lowest in the industry. This low cost means more of your investment goes towards growing your wealth, rather than being eaten up by fees. Over a decade, the impact of this low expense ratio can be significant compared to funds with higher fees. Furthermore, VOO's appeal is enhanced by its strategic management. The ETF is not actively managed by fund managers who pick stocks, but rather follow a predetermined index, ensuring that investment decisions are clear-cut and based on set criteria. This passive management style contributes to its low costs and eliminates the biases and errors that active management might introduce. Investing in VOO is akin to placing a bet on the broader U.S. economy rather than on the prospects of individual companies. This approach significantly reduces risks associated with individual stock investments and is ideal for those who prefer a set-it-and-forget-it investment style. Buffett himself has highlighted the effectiveness of investing in broad market indices for those who are not professional investors, but still wish to benefit from the stock market's historical upward trajectory. In its most basic form, VOO democratizes access to the growth of large, successful companies across various sectors of the U.S. economy, aligning with Warren Buffett's investment principles and offering everyday investors a simple yet powerful tool to grow their wealth over time. This makes VOO not just an investment product, but a gateway to financial participation in American economic success. When considering an investment in VOO, you must align it with your specific financial goals. This could range from saving for retirement, preparing for future educational expenses, or simply seeking to build wealth over time. Given VOO's track record and its reflection on the broader market, it serves as an excellent baseline for diverse investment strategies. Warren Buffett, a longtime advocate for index funds like VOO, often discusses the value of patience and consistency in investing. By consistently investing in a fund that tracks a major index, individuals benefit from market gains without the need to predict which stocks will perform best. VOO's structure allows it to be a significant part of any retirement portfolio. Since it includes companies from various sectors, it naturally diversifies its holdings, reducing the risk associated with fluctuations in any single industry. For someone planning retirement, this means that VOO can provide both stability and growth, as the fund participates in the overall upward trend of the market over time. For those interested in setting up a long-term investment that can weather market volatility, dollar cost averaging into VOO is a recommended strategy. DCA involves regularly investing a fixed amount of money into a particular investment, regardless of its share price. Over time, this strategy can help reduce the impact of volatility on the overall purchase. The benefit of applying DCA to an investment like VOO is that it minimizes some of the risks of entering the market at the wrong time, providing a smoother return profile by averaging out the purchase price of the shares. Moreover, the importance of reinvesting dividends cannot be overstated. VOO pays dividends that, while not the highest in the ETF space, provide a steady income stream that can be reinvested to purchase additional shares. This compounding effect is a powerful growth mechanism over time, particularly for young investors or those not needing immediate income from their investments. By reinvesting dividends, you increase the number of shares you hold, which in turn will generate more dividends, thereby accelerating the growth of your investment. Buffett also advises investors to stay the course, even during market downturns. The S&P 500, which VOO tracks, has historically recovered and provided positive long-term returns despite those short-term fluctuations. By maintaining your investment in VOO during these periods, you're likely to see recovery and growth as the market rebounds, which it has consistently done over the decades. For those crafting a more sophisticated investment strategy, it's beneficial to understand the tax implications of investing in an ETF like VOO. ETFs are generally more tax efficient than mutual funds due to their structure and lower turnover rates, meaning they typically generate fewer capital gains distributions. This makes VOO an attractive option for taxable investment accounts, where tax efficiency is a consideration. By integrating VOO into your investment portfolio, you adopt a strategy endorsed by one of the greatest investors of our time. Its broad market exposure, combined with strategic contributions and reinvestment of dividends, positions VOO as a valuable investment for both new and seasoned investors aiming for long-term financial growth. To determine how much you need to invest in VOO to sustain a comfortable lifestyle solely from your investment returns, you must first understand the fund's yield and growth potential. VOO's current dividend yield hovers around 1.3%, which is a key figure for those relying on investment income to cover living expenses. Let's put it into perspective. If you aim to generate an annual income of $40,000 from dividends alone, you would need to invest approximately $3,076,923 in VOO, given its 1.3% dividend yield. This calculation shows the challenge of relying solely on dividend income for substantial financial needs, especially for those who might not have substantial capital to invest initially. However, an alternative approach involves accumulating shares over time. For example, if you're starting with a more achievable investment amount, like $500 per month, and plan to continue this investment over 30 years, using an average annual return of 8%, which includes reinvestment of all your dividends, this method could amass a significant sum. Under these conditions, your monthly contributions could grow to over $745,000 by the end of the period, illustrating the power of consistent long-term investing. This situation shows not only how important it is to invest regularly, but also how beneficial it is to use compound interest and reinvest dividends, two strategies that Warren Buffett often promotes as the key to getting rich. It's not just about the size of the investment, but the strategy of regular, disciplined contributions that grow over time. For those unable to make large initial investments, this gradual approach to building a VOO portfolio can be more practical. It demonstrates that starting small does not stop investors from achieving substantial long-term growth. This method is particularly suitable for individuals early in their careers or those on lower incomes who can benefit from the market's potential for high returns over many years. Moreover, the concept of adjusting investment amounts based on financial capacity and market conditions is a must. As your financial situation improves, or as you approach different life milestones, you may choose to increase your monthly investment amount or make additional lump sum contributions to your VOO holdings. These adjustments can significantly enhance the growth of your investment over time. Additionally, it's vital to have realistic expectations of market behavior. While VOO has historically provided good returns, the market is subject to fluctuations, and there are periods of downturn that can affect portfolio values. Warren Buffett advises that the best way to counteract these fluctuations is to remain invested over the long term, as the market has consistently recovered and reached new highs over the decades. In this context, investing in VOO is not just about preparing for retirement or accumulating wealth. It's about adopting a disciplined investment strategy that aligns with your long-term financial goals. By understanding the mechanics of VOO, utilizing strategies like dollar cost averaging and reinvesting your dividends, even modest monthly contributions can grow into a significant nest egg, proving that sound investment practices can lead to financial independence and security. Integrating VOO into your long-term financial planning involves more than just understanding its structure and potential returns. It requires a strategic approach suited to your personal financial goals and life situation. Whether you are planning for retirement, saving for a major purchase, or building an educational fund, VOO offers a reliable foundation for these financial objectives due to its broad market exposure and historical performance. For those particularly focused on retirement planning, Warren Buffett recommends a thoughtful consideration of how much you'll need to withdraw annually from your investment portfolio to maintain your lifestyle without depleting your funds. For the sake of example, following the commonly advised withdrawal rate of 4%, consider a safe figure to help ensure that you don't outlive your savings, means you would need a substantial total in your VOO investment to sustain long-term withdrawals. If your annual living expenses are around $40,000, aiming for a portfolio size of $1 million in VOO shares would be a prudent target to meet these expenses sustainably. This strategic planning also involves considering the impact of inflation on your retirement savings. Over time, inflation can significantly erode purchasing power, which means the amount you'll need to live off comfortably today may not suffice in the future. Incorporating an annual adjustment rate for inflation in your withdrawal strategy is very important. For example, if inflation averages 2% per year, you should plan to increase your withdrawals by this amount each year to maintain the same standard of living. Another vital aspect of long-term financial planning with VOO is the reinvestment of dividends during your accumulation phase. Reinvesting dividends allows your investment to grow more substantially and rapidly through the power of compounding. This strategy can significantly increase the value of your VOO investment over the decades, providing this larger base to draw upon once you begin making withdrawals. Furthermore, it's important to periodically review and possibly rebalance your portfolio. As you approach major life milestones, such as nearing retirement, the allocation of your investments in VOO might need to be readjusted to reflect a more conservative approach, reducing exposure to market volatility. This might involve shifting some of your investments into bonds or other lower-risk assets, which can provide more stable returns and preserve capital. Additionally, staying informed about changes in tax laws and investment regulations that could possibly impact your VOO holdings is of the utmost importance. Understanding the tax implications of your investment decisions can help you optimize the tax efficiency of your withdrawals from VOO, ensuring that you keep more of your hard-earned money. Lastly, Buffett encourages investors to maintain perspective and not react hastily to market dips or swings. Long-term investing is about remaining committed to your strategy despite short-term market fluctuations. Keeping a long-term perspective helps mitigate the risk of making poor investment decisions based on short-term market movements. By carefully planning how much to invest in VOO, considering inflation, reinvesting dividends, adjusting your strategy as you near retirement, and staying informed about tax implications, you can effectively use VOO as your starting point for your long-term financial planning. This approach not only aims to grow your wealth, but also protects it, allowing you to achieve financial security and peace of mind in your later years. Understanding how much you need to invest in VOO to live comfortably requires both knowledge of the ETF and strategic financial planning. Whether you're a college student just starting out or someone on a low income, the key to success is a consistent long-term investment. Remember, it's not about how much you start with, it's about how consistent you are with your investments. Warren Buffett reminds us that the most powerful factor behind investment success is not the market's performance, it's the behavior of the investor. How do you plan to implement these strategies into your financial planning? Share your thoughts and questions in the comments below. And if you found this video helpful, don't forget to like, subscribe, and click the bell icon for more insightful investment advice.